Good afternoon and welcome everybody. Thank you to all of you for dialing in for this Adapting to Change webinar. It's certainly a topic that's very close to our hearts and probably everybody, as we've all had to sort of adapt and change to the circumstances over the last 6 months. It has certainly been quite an interesting period, if nothing else. But one, I think like everything, whenever you've got change, it creates opportunities, and I think we always want to be sort of cognizant of that, both in our own business and also in terms of the companies that we're looking to invest in. Indeed, I think it's one of our key sort of tenets that we sort of look for, is that in looking for a company to invest in, we want to see, is the management, is it capable of adapting to change? Is its business model robust? Are there going to be changes that are going to really have a detrimental effect on the business? And if so, can the management sort of deal with that? And so that's something, as I say, within our own business, we try to sort of do. Fortunately, we've been very lucky from the outset. We've spent a lot of money on improving our technology and our security, which meant that when the events of sort of February and March happened, we were actually quite well prepared. Even though we didn't know we'd be well prepared, we happened to be well prepared. So we were able to work from home nearly instantly with virtually 100% straight away. And I think, it's like a lot of these things in life where if you'd had various committees and consultants looking at your business and suggesting whether you could operate from home, undoubtedly, it probably would have taken several years to discuss the topic and probably not reach a conclusion. So sometimes when something's forced upon you, it's perhaps the best thing. In fact, someone said that necessity is the mother of invention, and that's certainly been the case. But I think, we've all taken on board the changes to it, and there's going to be more changes to come. I think we're going to go through this period of everyone probably quite like working at home. Obviously, some people don't. Some people maybe not in as good conditions as others, and probably missing the social interaction. And therefore, a number of people wanting to get back into that sort of environment where they have interaction with other people rather than just in their room or in their house on their own or with even family. So I think there will be that sort of period of those who continue working from home and those who are working back at the office or the factory or wherever it is. And I think there will be some sort of tensions that sort of that creep in there that we will probably all need to be sort of clear on. But it is change. I think the whole world is going through a period where not only on the COVID, but I think just generally in terms of the investment perspective, there's a lot more in terms of what's going to happen to us. Obviously, the last 20 or 30 years we've been through the technology revolution. I think that's probably going to go on even further. We've got quantum computing sort of coming down the rails in the next 10, 15 years, which is going to transform totally our computing sort of capabilities and experience to date. And this is something that I think we want to be mindful of. We have to probably ignored people. I think a lot of people thought everything's okay. I think at least the lockdown would be able to, I suppose, give people the time to sort of reflect that actually maybe there is more to life than just the absolute sort of returns. I need to make sure that I'm getting my investment returns, but in a way that isn't destroying the environment, and also in a way that's socially acceptable. And again, recent events over the last month or two has probably brought that more to the fore. So those are the areas that we want to always try to keep at the forefront of our minds. That business was always predicated on the fact that it's a partnership that we have, or that we want with our clients, and a partnership can only actually really work if there's fundamental respect between both parties, and that's a mutually beneficial relationship. So I think if you have that as your core tenet and you respect your fellow employees and your staff or whoever it is the partnership in its widest possible sense is working with, then I think we probably avoid many of the problems that we have seen around us. So that's something that we try to sort of keep at the core. And it's the same with, you know, the employees working from home. You know, people initially thought, well, you know, can you trust your employees to work from home? And I think the simple retort would be, well, if you can't trust them to work from home, then you've probably got the wrong people. So hopefully, if you've recruited the right people who've got the right approach and mindset and trust, then whether they're working from home or working in the office, then it doesn't actually really matter. So anyway, I think I've got Jonathan Marriott with me today, who's our Chief Investment Officer. Jonathan's going to go through a bit of a review of the last 6 months. It certainly has been that. We've got a stock market that is behaving in complete opposite direction to maybe world's economic events. So a little bit of a reflection on that 6 month period, but also a little bit in terms of, you know, where we're going from here and how do we actually best navigate it. So once again, thank you for all of you, for all of your support and your continued sort of trust in us. It's something that I assure you we will never ever take for granted. I always stress that we've got to continually earn the right to look after our clients' money, and that it can never ever be taken for granted. So I think if we try to keep that at the forefront of our minds, that we've got to continually earn the right to look after your money, and that we're very honoured to have our clients entrusted with us, then hopefully we should be able to maintain a very strong partnership with you. Just before Jonathan starts, I do have to give some compliance disclaimer. Please note that anything that he says is not an investment recommendation. You shouldn't act on it. I think that's probably all I need to say. I'm sure the compliance department will tell me I should have said more, but that's effectively it. So nothing he's going to say is an investment recommendation. So thank you, and over to Jonathan. Many thanks.
Good afternoon, everyone. As David said, we've been a bit of a peculiar market really the last quarter. When I look back to the first quarter, we saw steep falls, and in the second quarter, but the economy held up. In the second quarter, the markets seem to have been defying the gravity of the economics. When we look at the situation we find ourselves in today, with half the world in lockdown, we can't ignore the fact that 500,000 people have died. This will have affected many of us directly or indirectly, and each one is an individual tragedy. I know in my case that we've got friends of the family who've suffered here really badly, and it's something we can't get to escape. But when we're looking at investments, we have to be a bit dispassionate, I'm afraid, and look at this in the hard light of day, and look at it in terms of what's actually happening. Even when the vaccine has been found, if there is one, and we've got treatments that work, the impact will not go away. Cancer Research UK have said that 2,700 people a week are being undiagnosed with cancer during the lockdown period. I mean, they may be catching up with that now. And there's a report at the beginning of this week, there's as many as 35,000 additional deaths may come about as a result of this. So the pressures on the NHS won't go away, and the support that they need will also be continuous rather than something that falters. However, we do have to look at the economic damage, and in the first quarter, the economic damage was really not felt because the shutdown didn't really take place until the end of March. But in the second quarter, we've begun to see some of the data come through that indicates what's going on. Unfortunately, from an economic point of view, it's actually very difficult to actually read some of the numbers. The RPI in the UK index, 20% of items had to be basically guesstimated by the ONS because they couldn't actually measure them. So that was things like drinks in pubs, dental appointments, travel, all of which weren't taking place and couldn't actually be priced. So inflation measures are wrong, and unemployment are even more wrong. In the US, 51 million people have benefited from the Paycheck Protection Plan, according to the Small Business Administration. That's out of a workforce of 160 million, so that's nearly a third. 500,000 businesses have applied for their Paycheck Protection Plan. In this country, when you combine the furlough scheme with the self-employed scheme, 11 million people have been benefited and have been kept off the unemployment register by those schemes. And we're beginning now on both sides of the Atlantic to see some of these schemes unwind, or the effects of them being unwound. United Airlines announced overnight that 45% of their workforce had been sent letters that they were at risk. That's 36,000 potential jobs lost there. Over lunchtime today, we've seen John Lewis announce 8 stores are closing with 1,300 job losses, and Boots, the pharmacist, we thought a pharmacist would be relatively exempt, 48 shops closing with the loss of 4,000 staff. So Rishi Sunak's message yesterday to bolster jobs was most welcome. And really what the stock markets have been doing on a broad scale of things is they've been balancing the enormous measures of support that have come both fiscally and monetarily to the economies around the world. Even the Germans have abandoned their balanced budget plan, which has been in place since the war, to stimulate their economy. So we're getting massive stimulus to the economy. We've seen some parts of the economy getting back to work, with the notable exception of some parts of the US and some of the emerging markets. But there has been some hope that people are getting back to work, which is good news. And there has been some progress on treatment and vaccines. There seem to be numerous different vaccine combinations, but let's hope that one of them works and that we can all get back to work soon. When it comes to the economics, we get a whole alphabet of possible outcomes that's talked about, whether it's a U-shaped recovery, a V-shaped recovery, a W-shaped recovery, an L-shaped. The nice swish was one, the square root, which is a sharp drop, sharp bounce back, and then a flat line. But when we're looking at markets, particularly in equity markets, you've got to remember they're made up of individual companies, and individual companies will experience all of these in different parts of their business patch. There'll be a U, W, an L, a swish, square root, whatever you like, but there's going to be different companies, some of which have done very well through this crisis and actually benefited from it, such as Amazon with the move to online shopping, against those in the sort of travel business and the retail stores who are on the other side of that equation will be almost wiped out. So dispersion of returns within markets and even within sectors has been absolutely massive. The NASDAQ index, which includes tech stocks in the US, is up 17%. The S&P 500 there is down 2% year to date, and the FTSE index is down 18%. So you've got plus 17 to minus 18 on some fairly major indices. You've got Amazon up 66% and Microsoft up 35%. These are huge moves. The FTSE, the index in the FTSE index is made up of things that are really very, very different to many indexes in other parts of the world. There's relatively little tech, and there's a high content that's in oil, BP and Shell in particular, and in materials. And in the first quarter, the oil had given us a real shock, with Saudi and Russia in dispute and increasing supply into a falling demand, to try and put the shale oil producers in the US out of business, if anything. The West Texas Intermediate future went negative as there was a lack of storage facilities, and so when deliveries came about, there was nowhere to put the oil for a time. They then cut oil production by 10 million barrels a day, and that was pretty pathetic, frankly, when there was a 30 million cut in demand. So the cut is not adequate. There has been some pickup in demand. There has been a recovery in the price from the lows, but it's still well down on the year, and the oil companies have suffered. When it comes to that, we've seen Shell, amongst many other companies, cut their dividend, and dividends and share buybacks have been part of the support, part of the conditions for the support that has been provided. So the FTSE 100 index, which has been also supported by dividends, has also been hard hit because it was one of the biggest dividend pairs, and the dividends there have not quite been, it would look as if they'll fall to around 3% from perhaps over 5% at one stage. So the dividend yield there is dropping away. but with interest rates at less than 0.2%, even a 3% dividend yield will look relatively attractive. So the fiscal and monetary support has been extraordinary. Interest rates have been cut, and bond buying has been instigated, with the Federal Reserve buying corporate bonds for the first time in the US. This has given us some comfort that corporate bonds will hold up relatively well. And perhaps those that questioned holding government bonds at the beginning of the year should look at the returns that have been achieved in terms of balancing portfolios. So when we look at the changes, and David referred to a number of the sort of changes in the way we live that have been going on, I would just like to think about whether they last and whether we look through them to the future. I think the number of trends have been in place for 4 or 5 years, and they've been massively accelerated by the lockdown process that we've had. The online shopping in particular, clearly nobody wanted to go to the shops, and most of the shops weren't open, and so Amazon and anyone who had a good online presence benefited from that. The high street is dying. I highlighted Boots and John Lewis closing down shops here, but this is going to be across the world. And I think that people talk about trying to save the high street. I think you've actually got to repurpose the high street, because this is a trend that's going to continue. Working from home has clearly benefited the technology. I know that we ordered a number of extra monitors for our staff so that they could continue to work efficiently at home. And so that's certainly given us a boost. And I think that there will be more people working from home. This probably has a knock-on effect on property. And speaking here from a farmhouse in Kent with a garden, I'd like to think that properties with gardens out of town will benefit relative to flats in town, particularly for families who have realised that being cooped up in a flat during lockdown is not a nice thing. And you don't necessarily need to commute every day to work. So I think that may shift that. And while talking about UK property, it's interesting to notice that the Royal Institute of Chartered Surveyors have shown in their latest survey, first thing this morning, there's a very marked pickup in activity, and the new buyers are at the highest level they've been for 10 years since the recovery from the financial crisis. Other trends may be slightly less long-lived, I feel. The move away from globalization, which has taken place as a result of people questioning supply chains. When China sort of closed down back in February, there was a lot of worry about supplies of parts, meaning factories had to close, not because of coronavirus, but because they couldn't get parts for making things. And so there's talk about bringing supplies closer to home. I think if that costs a lot of money, then that may be something that memories will be relatively short-lived with. I think the level of support for the NHS has zoomed up enormously. The amount of money that has been pumped into it is huge. The problems for the NHS won't end with COVID virus, and the support will continue. But as we go through, in the years to come, if we don't get another pandemic, and then some of these fears will gradually wane, and the costs will still be massive there. So whether they actually get the degree of funding that they need will be questionable, I suspect. Ultimately, when it comes to the economy, it's vaccines and therapies that are hope, and we have to look through that. But as far as moving away from COVID, there are other things that are going on in the world. And I really want to highlight two particular things at the moment. One is the US election. And again, we have to talk about Trump and his reaction to COVID, which has not gone down well. I think there's the old message that I think Clinton used in his presidential campaign. It's the economy, stupid. And Trump has his strongest card as being the economy up until now. But with that suffering, he's desperate for the US economy to get going, and was probably perhaps over enthusiastic in encouraging people to open up. When the COVID crisis started, the cases were in New York and California, both states that voted for Hillary Clinton at the election. A week ago, I saw a statistic that said 73% of new cases are now in states that voted for Trump. So if that continues, then he's in trouble. So we're talking about states like Florida, Texas, Arizona, all of which have had a surge of cases, and the reopening of the economy that took place in those places is beginning to have to be reversed, which is not good news for Mr. Trump. So beware of at the moment Biden is ahead by 10 points. I don't think he's a great campaigner. He almost needs to just keep his mouth shut behind a face mask to win at the moment. But Trump, when he's cornered, will fight back, and goodness knows where he'll lash out at. But China is certainly one of the places that is coming about. When we look at this side of the Atlantic, then the Brexit deadline for the extension that was set in the government's Act Parliament was now passed. I had thought that with Brexit they had an excuse to extend, and maybe they can go back and revisit that, but it would require amendment to the Act of Parliament, and certainly there is huge resistance to that within the Conservative Party at the moment. The gradual introduction of border controls has been talked about to ease it, so it's only a gradual introduction, but then there have been questions about the legality of that under WTO rules, whereby you couldn't treat the EU different to the rest of the world, so that could be questioned as well. The minds may be focused as we get towards year end, but if we look back at EU negotiations in the past, it's usually gone past midnight before they actually come to a conclusion on anything tricky, and it is a focusing on that. As far as the EU concerned, there's another stimulus package which is coming through, which will be which Merkel and Macron have both proposed, but it's held up by arguments within the EU, as is another proposed package coming out of the US for that matter. It's held up by Democrats and Republicans not agreeing with each other on how to do it. But I think in the next few weeks we will expect further packages of support to come out of both those areas. When I look back at history, and anyone who knows me knows I'm a bit of a fan of looking back at history, and I have written this up in a note with those who want it. But when we look back at history, what have you needed to do in response to a crisis? Well, it's more what you don't need to do. What you don't need to do is increase taxes. When you increase taxes during a crisis, that's always bad news. So we need austerity to be held back, and certainly in this country under a Boris Johnson government and under Trump, I can't see that they're going to be raising taxes, and they're going to continue to try and spend their way out of it, which frankly has been the message before, is you spend and grow and throw money at the problem to try and get out of it. You do not raise interest rates as well, so you keep things easy until you're well into the recovery phase. And so I think interest rates will remain low for a prolonged period. The other thing that history tells you was you don't want a trade war. It was a trade dispute basically with the US retrenching its putting trade tariffs in the 1930s that tipped them into the Great Depression, amongst other things. Trade oils the wheels of commerce, and we need to have trade. So if one of the concerns is that Trump lashes out at China with more trade tariffs, but it's notable that he's lashed out in terms of other things other than trade in his recent comments about China. It's suspending people's travel. It's been talk about Hong Kong's peg, but I think that's a bit of a red herring, because I think that would actually be more damaging to the people of Hong Kong rather than to China. So as we move forward, we look to concentrate, as we have done, on quality balance sheets and appropriate business models that are not too badly affected by what's going on, and secure things. That leads us to the sort of quality growth bias that we would encourage people to have in their portfolios. We think corporate spreads will be held up as people maybe cutting dividends and cutting buybacks, but that's probably increasing their balance sheet, and a lot of people have moved to strengthen their balance sheet, if anything. So with the Federal Reserve also buying credit, that's well supported. But dispersion, and as a result, dispersion between sectors, between stocks, between indexes will be substantial, and therefore we favour active managers who pick stocks have been successful stock pickers, and to concentrate on those sort of quality growth stocks. And volatility has been high. We've seen 2, 3, 5, even 10% moves in a day, at times. I think we're going to continue to see that. Investors are going to remain nervous. We encourage people to stay invested through the crisis and look through it to better times ahead. With gilt interest rates at 0.2, US Treasuries at 0.6, and German bonds at -0.45, I think that anything that can produce a profit or a positive cash flow is going to look very attractive. And so what happens in these circumstances, you get asset price inflation, and that is good for stocks, and is broadly supportive of even of bonds at these low yields. But it's basically positive asset prices, and that's positive for the equity market in the long run when we come out of this crisis. In the short term, movements may be sharp and volatile, but dispersion high, volatility high, returns positive in the long run for the equity market. That's all I had to say today. If anyone has any questions, please come back through your investment managers or speak to them about your actual portfolios and what's doing on that. And I'd be glad to take any questions from people if they're fed through that source. And on that note, I will thank you all for attending today, and hope that we can thank you for our trust in us in looking after your portfolios. Thank you very much.